All right, so let's dive into a topic that I think can be kind of a beast for level 2 candidates.
Yeah,
Exchange rates.
for sure.
We're not going to just like touch on it.
Right.
We're going to like really get into it.
Yeah, yeah.
Um, so for those of you who are, deep in your level 2 CFA prep,
Yeah,
let's kind of like take it back to the basics for a second.
you're right.
What are exchange rates?
So at its most basic level, an exchange rate is just a price.
Okay.
It's telling you the price of one currency in terms of another currency. So it's really just like any other price that you see in a market.
Okay, so like how many bananas does it take to get an apple?
Exactly. Yeah.
How much of one thing do you have to give up to get another thing?
Okay, cool. Now, I remember from level 1, there's a little more to it than that, right?
Yeah.
Like we have bid-ask spreads.
Yes.
We have all these different currency pairs.
Of course.
So let's maybe use an example just to kind of like illustrate this.
Sure.
If we're looking at the USD/EUR exchange rate.
What does that actually mean?
So that's telling us how many US dollars
Okay.
it takes to buy 1 euro.
Okay.
So in that case, the euro would be what we call the base currency.
Okay.
And just like any other price, like you
Yeah.
said, there's going to be a big price and an ask price.
Right. So the bid is like what a dealer is willing to pay
Yes.
to buy that base currency.
Exactly.
And the ask is what they're willing to sell it for.
Exactly.
So that difference is basically like their profit margin.
Exactly. That's exactly right. And that difference is called the bid-ask spread.
Okay.
And that spread's going to be wider for currencies that are less frequently traded
Okay.
because there's less competition.
Makes sense. So a really tight spread generally means that that currency is
Liquid.
liquid and
Yeah.
trades a lot.
Exactly.
Okay, cool. So this is kind of like bringing back some of those level 1 concepts.
Yeah.
But now, like, how does all of this relate to potential arbitrage opportunities?
Okay.
Because I remember that word from level 1, and it just like,
Sent shivers down my spine.
of course.
Um,
So arbitrage in the context of exchange rates,
mm-hmm.
it's not as scary as it sounds.
Okay.
Essentially what you're looking for are mispricings in the market
Okay.
that allow you to buy low and sell high simultaneously.
So you're looking for those loopholes.
Yeah, exactly.
Okay. But what are the kind of like constraints that make that possible?
Okay, so the main constraints are that a dealer's bid can never be higher than what's called the interbank offer rate.
Okay.
Because if it was this way, then anybody could buy at the interbank rate and immediately sell to the dealer for a profit.
Okay.
Similarly, the dealer's offer can never be lower than the interbank bid,
Okay.
because then someone could buy from the dealer and sell in the interbank market.
Got it. So it's like it's not a total free-for-all.
Exactly.
Like there are some rules.
Right.
But within those rules, we can find these little loopholes.
You got it.
Now, I'm guessing that these mispricings don't really happen
Yeah,
with like the major currencies.
that's right. Because they're being traded all the time.
Exactly. Those arbitrage opportunities disappear very quickly.
Okay.
But that doesn't mean they don't exist.
Oh, okay. So where do they exist then?
So a lot of times they can pop up in what are called cross-rate calculations.
Oh, cross rates. Okay. Remind me what those are again.
Sure. So a cross rate is when you're trying to figure out the exchange rate
Okay.
between two currencies that aren't directly quoted.
Okay.
So let's say, for example, you have the USD/EUR rate and you have the JPY/USD rate.
Okay.
But you need to know the JPY/U rate.
Mm-hmm.
You would use those two existing rates to calculate that implied exchange rate.
Got it. So it's like a little math puzzle.
That's right.
Okay. And those arbitrage constraints
Yes,
still apply.
they still apply to
Yeah.
these cross rates.
Okay. So how do we actually like figure out
Yeah.
if there's an arbitrage opportunity?
So there's a handy visualization that we can use called the number line method.
Oh, okay. That sounds interesting.
Yeah, so you plot the interbank bid and offer for the relevant currencies on a number line. Okay. And then you place the dealer's cross rate on that same number line.
Okay.
If the dealer's rate falls completely on one side of the interbank quotes,
Mm-hmm.
that's when you know there's a potential arbitrage opportunity.
So if it's like outside the bounds
Exactly.
of the market, then boom, you can make some risk-free profit.
That's right.
Awesome. I'm starting to see how this all comes together.
Yeah.
Now, this is all about spot exchange rates, right?
Correct.
What about this mystical world of forward markets?
Uh-huh.
Forward contracts have always seemed a little,
Yeah.
like, I don't know.
It's not as complicated as it seems.
Okay.
So think about a forward contract as just setting today's exchange rate
Okay.
for a transaction that's going to happen in the future.
Okay.
So for example, let's say you're a company
Mm-hmm.
and in 6 months, you have to make a payment to a supplier in euros.
Okay.
You could enter into a forward contract today to lock in that exchange rate.
So it's kind of like insurance in a way
That's a great way to think about it. Yeah.
against those fluctuations.
Exactly.
Okay. So how is that forward rate determined?
Okay, so it all comes down to interest rate differentials.
Okay.
So if the base currency, let's say the euro in our example, if the euro has a higher interest rate than the US dollar,
Right.
times the forward rate for the euro is going to be lower than the spot rate.
Okay.
And that difference is called a forward discount.
Okay.
And it reflects the expectation that the higher yielding currency is going to depreciate over time.
So it's not just about like locking in a rate today. It's
Exactly.
also taking into account like
Yes,
the future expected moves in that currency.
exactly.
Okay.
You got
It's a really important distinction,
it is.
I think.
Yeah.
Now, once we understand how that forward rate is determined,
Right.
then we can figure out how to actually value these contracts as time goes by.
That's right. And that's where the concept of mark-to-market comes in.
Okay.
But maybe we should take a quick break,
Okay.
and then we can come back and talk about that.
Sounds good.
Yeah.
Okay, so we're back, and we've talked about how these forward rates are determined.
Right.
But how do we actually value these contracts
Yeah.
as like time passes
Yeah, that's a great question.
and like market conditions change?
Right, so that's where this concept of mark-to-market comes in.
Okay.
And it basically tells us the profit or loss on the contract
Right.
if we were to close it out today.
Got it.
So to calculate that, we create what's called an offsetting position.
Okay.
So if we initially bought euros forward,
Mm-hmm.
we would now sell euros forward at the current market rate.
Okay.
And the difference between those two rates,
Okay.
discounted back to today,
Okay.
gives us the mark-to-market value.
So it's like a hypothetical scenario
Exactly.
of like unwinding that original position.
Exactly.
Got it.
Yeah.
Okay, that makes sense. Now, what about all those parity conditions that we learned about?
Right.
I know they're kind of like theoretical,
Yeah.
but can they actually like guide us in making investment decisions?
Absolutely. So they provide a framework for understanding the relationships
Okay.
between exchange rates, interest rates, and inflation.
Got it.
So let's say, for example, you're an Australian asset manager
Okay.
and you're looking at opportunities in Japan
Yeah.
where interest rates are significantly lower than in Australia.
That's screaming carry trade to me.
Ah, yes, the classic carry trade.
Right. You borrow cheap yen.
Yeah.
You invest in those higher yielding Aussie dollars.
Right.
Easy profit, right?
Well, not so fast.
Okay, why not?
So you have to consider what's called uncovered interest rate parity,
Okay.
which suggests that the Japanese yen should appreciate against the Australian dollar
Okay.
to offset that interest rate differential.
So my profit that I'm making from the interest rate differential
Yeah.
could be eaten away
Exactly.
by the move in the currencies.
Exactly. So
Right.
that's where these parity conditions can come in handy.
Okay.
So, for example, purchasing power parity can give you a sense of whether the currencies are overvalued or undervalued based on relative price levels.
Got it.
And then the international Fisher effect can shed some light on whether those interest rate differences are driven by expected inflation.
So it's like a whole toolkit
Exactly.
that we can use to kind of like
Yeah,
investigate these opportunities.
exactly.
Cool. Okay, so we talked about like all these different things, but
Right.
in the long run, like what are the forces that really drive these exchange rates?
Okay, so one of the key things to remember
Mm-hmm.
is that countries with persistent current account deficits
Yeah.
tend to see their currencies weaken.
Okay, we talked about that earlier.
Right.
But how does that actually like play out in the market?
Okay, so it really comes down to the basic forces of supply and demand.
Okay.
So when a country is importing more than it's exporting,
Mm.
that means they need more foreign currency to pay for those imports.
Okay.
So that creates higher demand for foreign currency and lower demand for their own currency,
Okay.
which puts downward pressure on its value.
So it's like any other market.
It's
More buyers than sellers,
yeah,
the price goes up.
exactly.
But in this case, the price is the exchange rate.
Exactly. You got it.
Okay, cool.
Yeah.
And if that deficit persists,
Right.
then they might need to actually like borrow money from abroad,
That's right.
which then leads to like a buildup of foreign debt,
Exactly.
which can then further erode confidence
Exactly.
in that currency,
Exactly.
leading to even more depreciation.
Yep. Vicious cycle.
So a persistent current account deficit is like
Yeah.
big warning sign.
It definitely warrants attention.
Okay.
Mhm.
Now let's say you're a government
Okay.
and you're trying to like manage your exchange rate.
Right.
What are the tools that you can use?
Okay. So one thing that governments can do is they can intervene directly in the market.
Okay, I've heard about that.
Yeah.
Like how effective is that really?
So they can try to influence the exchange rate
Okay.
by buying or selling their own currency.
Okay.
So if they want to prop up the value of their currency, they'll use their foreign exchange reserves to buy their own currency in the market.
So they're basically like manipulating supply and demand.
Exactly.
Okay, I bet it's not that easy, though.
You're right. It's not always that simple.
Yeah.
The effectiveness of this intervention depends on a lot of factors,
Okay.
including the size of the country's economy and the volume of trading in that currency.
So, like, how much power do they actually have
Exactly.
to kind of, like,
Right.
fight these global forces?
Exactly.
Okay. What other tools do governments have?
Another tool that governments use are capital controls,
Okay.
which are basically restrictions on the flow of money in and out of the country.
Okay.
So they can try to limit speculative capital flows that might contribute to volatility.
So it's like putting up some guardrails
That's a great analogy, yeah.
to keep that money from
Exactly.
rushing in and out.
Yeah.
Okay. Do those controls actually work?
Well, it's debatable.
Okay.
Their effectiveness really depends on how strictly they're enforced and the overall economic climate.
Got it.
Sometimes they can create more problems than they solve.
Sounds like it's a bit of a balancing act.
It is.
Okay, so now I know we talked about currency crises.
Yes.
If I'm an investor and I'm like looking at these emerging markets,
Right.
are there any like red flags I should be watching out for
Yeah, that's a great question.
that might signal that like trouble is ahead?
So emerging markets can be very alluring,
Yeah.
but it's important to be aware of the risks.
Okay.
Some warning signs to watch out for
Mm-hmm.
would be things like large and persistent current account deficits,
Okay.
a rapid buildup of foreign debt,
Okay.
high inflation,
Yeah.
an overvalued exchange rate,
Okay.
which makes their exports uncompetitive,
Got it.
and then dwindling foreign exchange reserves,
Okay.
which signals that the country might not be able to defend its currency.
So basically it's a mix of
Yeah.
economic imbalances and like
Exactly.
a loss of confidence in
Exactly.
the government's ability to kind of like manage things.
You got it.
Okay.
And of course, political instability or any kind of unexpected global event
Right.
can also act as a trigger,
Yeah.
even if a country's economic fundamentals look okay.
So it's not just about the numbers.
Exactly.
It's also about like the overall sentiment.
That's right.
Okay. So it seems like with these emerging market currencies,
Yeah.
it's not just about looking at the economic
Yeah.
data,
Right.
but also like really understanding the political landscape
You got
and what's going on globally.
Exactly.
Okay. Wow, this has been super insightful.
Yeah.
But also like a lot of information.
It is a lot to take in.
Yeah. So for our listeners out there who are like prepping for this level 2 exam,
Right.
is there a way to kind of like distill this down
Absolutely.
into some key takeaways?
So the key is to really focus on those fundamental building blocks.
Okay.
So first, thoroughly understand how exchange rates are quoted, the bid-ask spread,
Yep.
and how to spot those arbitrage opportunities.
Those are like the essentials.
Exactly.
Okay.
Make sure you're comfortable calculating forward rates, forward premiums, and discounts,
Okay.
and the mark-to-market value of those forward contracts.
Got it.
Those are prime targets for exam questions.
I'll definitely be brushing up on those formulas.
Good.
Anything else?
Next, master those parity conditions.
Okay.
Understand what they imply about exchange rate relationships.
Yep.
And be ready to apply them to real-world scenarios.
So it's not just about memorizing the definitions.
Exactly.
It's about like really understanding how to use them.
Exactly. And then finally, don't lose sight of the big picture.
Okay.
How factors like balance of payments,
Yep.
government policies,
Mm-hmm.
and capital flows
Yep.
influence exchange rate movements over time.
So it's like having that mental map
Exactly.
of the landscape.
Yep.
And knowing kind of like the forces that shape it.
You got it.
Okay.
It's a lot to take in, but with focused study and practice,
Yeah.
you'll be well prepared to tackle this section of the exam.
Awesome advice. Well, we've covered a ton of ground,
We have.
but there's still more to explore.
There is.
In the final part of our deep dive,
Yeah.
we're going to delve into some of these like advanced concepts
Okay.
and really put your knowledge to the test.
Sounds good.
So stay tuned. Okay, so we're back for the final part of our exchange rate deep dive. And we've talked about a lot of these foundational concepts.
We have.
Now let's get into some of these like more advanced frameworks,
Okay.
like the Mundell-Fleming model.
All right. Yeah, the Mundell-Fleming model, it can seem a little intimidating at first,
Yeah.
but it's really about understanding how changes in monetary and fiscal policy
Okay.
can impact exchange rates.
So it's like a chain reaction almost.
Exactly.
Okay. So let's start with like expansionary monetary policy.
Okay.
So a country decides to lower interest rates
Right.
and increase the money supply.
Okay.
What happens?
So if interest rates are lower, that makes holding that country's currency less attractive to investors. Right, because they can earn a higher return elsewhere.
Right, they're going to go chasing yield.
Exactly. So you're going to see capital flowing out of that country,
Okay.
looking for those higher returns.
And what impact does that have on the exchange rate?
So that outflow of capital is going to put downward pressure on the currency, causing it to depreciate.
So it weakens the currency.
Exactly.
Okay. Now, what about expansionary fiscal policy?
Okay.
So like tax cuts or increased government spending.
Right.
What happens there?
So this one's a little trickier.
Yeah, it is a little trickier.
Because when a government increases spending or cuts taxes, they often have to borrow more money to cover that difference.
Right.
And that increased demand for borrowing can push interest rates higher.
Oh, so it's the opposite.
Exactly.
Okay. And then those higher interest rates can attract foreign capital.
That's right. So now you have capital flowing into the country,
Okay.
drawn by those higher returns.
So it strengthens the currency.
Exactly. And that inflow of capital is going to put upward pressure on the exchange rate, leading to appreciation.
Okay, so we've got monetary easing generally weakening the currency.
Right.
And fiscal expansion can strengthen it.
That's right.
But you mentioned earlier the capital mobility,
Yes.
the key factor here.
Yes, it is.
Can you elaborate on that a little bit?
Sure. So capital mobility just refers to how easily money can flow across borders.
Okay.
So in economies with high capital mobility, think like developed countries with very open financial markets,
Yep.
those capital flows happen really quickly,
Got it.
which amplifies the effects of these monetary and fiscal policies on exchange rates.
So with high capital mobility,
Yes.
that expansionary monetary policy would lead to a more pronounced depreciation.
Exactly.
An expansionary fiscal policy would lead to a stronger appreciation.
That's right.
Okay. What about when capital mobility is low?
So when capital mobility is low, things get a bit more nuanced.
Okay.
Because now trade flows become the dominant force.
Correct.
So you have to consider how those policies are going to impact imports and exports.
So it's not just like a one-size-fits-all kind of thing.
Exactly. It really depends on the specific circumstances of that economy.
Okay. Now, what about the portfolio balance approach?
Okay.
We touched on that a little bit earlier.
Yes.
How does that differ from the Mundell-Fleming model?
So while the Mundell-Fleming model focuses on those shorter-term impacts,
Okay.
the portfolio balance approach considers the long-term consequences
Okay.
of things like government debt.
Got it.
So as that debt stock grows,
Mm-hmm.
investors might start demanding higher interest rates to compensate for the risks.
Which could ultimately weaken the currency.
Exactly, even if those expansionary fiscal policies initially boosted it.
Right. So it's like you have to think about both the short term and the long term.
Absolutely. It's a very dynamic situation.
Okay. Now, before we wrap up, I want to touch on those currency crises again.
Okay.
For our listeners who are prepping for the Level 2 exam,
Right.
are there any telltale signs that they should be watching out for?
It's tough to predict those crises with certainty,
Yeah.
but there are some classic warning signs.
Okay, like what?
Things like large and persistent current account deficits,
Okay.
rapid credit growth that's fueling unsustainable bubbles,
Mm-hmm.
high inflation that's eroding purchasing power,
Okay.
an overvalued exchange rate that's making exports uncompetitive,
Okay.
and then dwindling foreign exchange reserves,
Got it.
which signals that the country might not be able to defend its currency if things go south.
So it's like this combination of
Yeah.
economic imbalances
Exactly.
and a loss of confidence.
You got it.
Okay.
And of course, political instability or unexpected global events can also act as triggers.
Right. So it seems like to really understand exchange rates,
Yeah.
you need to not just understand the models,
Right.
but also what's going on globally
Yes.
and how all these pieces fit together.
You got it.
Well, this has been quite a journey.
It
I feel like we've really demystified some of these key exchange rate concepts.
Yeah, I hope so.
And hopefully given our Level 2 candidates a lot to think about
Absolutely.
as they prepare for the exam.
For sure.
So to all of our listeners out there, best of luck with your studies.
Yes, good luck.
And we'll catch you next time on The Deep Dive.